Hi, I'm Bob.Woolverton, your Northwest Realty Advisor. Earlier this week, I had a client ask me if it made sense for them to pay the extra money to purchase mortgage discount points, in essence, buying down the interest rate on their mortgage. Well, the answer is that is going to be different for everybody because your circumstances are different. But I'm going to show you how to calculate that answer so you'll know whether it's a good investment for you. So stick around. I'll show you how to do that when we come back in 8 seconds. Okay, so in this example, we're going to use a loan amount of $500,000. When we talk about points, points are 1% of the loan amount. So if the loan amount is $500,000, 1% of that is $5,000. 2 points is $10,000. So when we do that, if we were to pay the $10,000, what does that mean to you as the mortgage holder? Well, in this example, we're going to say if you didn't buy any points, that your mortgage rate would be 4.5%. But if you buy 1 point, it would lower 1/4%. Or if you bought 2 points, it would lower it down to 4.0%. So what that means to you is it lowers your monthly payment from a little over $2,500 to $2,459 to $2,387 if you buy 2 points. So when we look at the monthly savings, in essence, 1 point is going to save you $73.70. Now this is just on the principal and interest. Your mortgage payment will also have an escrow account where they put in reserves every month for the annual insurance payment, for your property taxes. If you have private mortgage insurance on your loan, it all goes into that escrow account. What we're talking about here is just the mortgage principal and interest. That's all that this is going to affect. So in essence, off of that, it would save you $73.70 if you purchase 1 point. 2 points would save you $146.35 each month if you bought 2 points. So the way we calculate is we take that example, like the $146.35, divide that into the $10,000 to see how long it's going to take you to recoup that money back. So that's going to take you 68 months. So that's part of the decision-making process right there is, do you plan to stay in this home for at least 68 months because it's going to take you that long to just break even? Now, if you stay longer than the 68 months, say you stay the full 30 years of your mortgage, you can turn that $5,000 into $26,000, or that $10,000 turns into $52,000. Well, is that even a good investment? Let's say, I'm going to stay there longer in 68 months. I plan to stay there the full 30 years of the mortgage. I know it's going to turn into $52,000 or save me $52,000 in essence. Is it worth it? Well, when we do the calculation on that, you're basically going to earn 5.7% on that money that you put out up front. But the key criteria here is whether you're going to stay a minimum of the 68 months to even break even. And then the longer you stay, the more that you're going to benefit from this. Now, I'm going to give you a little bonus here. I'm going to show you how we calculate this 5.7%. Okay, so what you have to do is you have to get a financial calculator. And there's lots of apps that you can get. I use an app on my phone. It cost me $4.99. I use it a lot, so it was a good investment. But we open up the financial calculator, and the first thing we want to do is when we're calculating interest that we earn, it's 1 period per year that it compounds, whereas interest we pay, we calculate it 12 times per year that it compounds. So we need to change this to 1 gold key and enter that 1 as the periods per year. And now we want to clear everything out of the memory, so we're going to do gold key, clear all. Now in this case, we're going to buy 2 points. So we're going to enter $10,000 as the money that we spend. Because we're spending it, it's a negative number because it's going out. It's a disbursement, and that's our present value. Now that money is over 30 years is going to turn into $52,686.03. That's going to be our future value. So we press FV. This is going to be a 30-year term, so 30 for the term, and then we hit the interest button, and there's our interest rate, 5.7% on that $10,000 that we invested. So that's how we calculate the return there. But the 2 important things to remember are how much it's going to lower your monthly payment, how long it takes you to recapture that money, do you plan on living there that long, and then if you do, you can get an estimate on what kind of return that you'll get on your money and whether it's a good value for you. That's the short and simple answer of how to calculate whether buying points, buying down your interest rate makes sense in your particular situation. I'm Bob.Woolverton, your Northwest Realty Advisor. I've got a favor to ask of you this week. If there's a topic that you would like for me to cover in my videos, please send me an email or put it in the comments below. Give me some ideas of what you would like to see on this channel. We put out new videos every week. I try to come up with new things that I think you're interested in. This one was the result of a client asking me this question, so I thought, if one person has this question, more people have this question. I put out new videos every week. Hit that subscribe button. You'll get notified when I do. We'll see you next week.